My baseline expectation for today's meeting is for the Fed to increase interest rates by 25 basis points. That would be the same pace that they delivered at the February meeting, which, if you remember, was a stepping down or a slowing in the pace of monetary tightening. However, if you compare the expected interest rate increases versus what we had priced in before the bank failures here in the U.S., it is much lower. And I think also market expectations for the quarters ahead have declined significantly.
Well, the inflation picture has deteriorated, but the banking issue has emerged. Can the Fed really deal with inflation in isolation anymore?
I think this is a real test for the Fed and for regulators here in the U.S. I feel that the Fed right now is in between a rock and a hard place. They have inflation pressures that have accelerated since the beginning of the year. The tightness in the labor market persists. And when you look at economic indicators for both January and February, they make the economy look strong and like growth was accelerating. But then on the other hand, we have clear problems with the financial sector and financial markets at the moment, a lot of volatility, a lot of stress, and we're all trying to figure out the extent to which this can spread to the rest of the financial sector. So right now, I think the Fed will need to balance its financial stability responsibilities and its inflation fighting and price stability targets. So in this situation, I think it'll be very important for them to highlight that they have different tools in their toolkit to deal with these different problems.
Yeah, it's a conundrum, isn't it? Because if the Fed raises too little or not at all, it could lead to a resurgence in inflation, but could also cause further panic in the banking system. Just how important is it to contain fear right now?
So I think communication is key. What comes after the Fed hike? How are they going to address forward guidance? I think in this very uncertain environment, they cannot provide a lot of forward guidance, but they can reassure markets that they will do the right thing as more information emerges, as more data come in. But it is a pretty fine balance for them to strike right now.
So if an interest rate hike is delivered of 25 basis points, do you think it will be the last?
Right now, my baseline assumption is that it will not be the last. I think the Fed has some more work to do when it comes to bringing down inflation here in the U.S. Core inflation remains both elevated and sticky. And the job numbers that we're seeing and the wage data that we're seeing are simply not consistent with that inflation target coming down or that inflation number coming back down to target in the next few months. So based on that, I think there's going to be a little bit more hiking that needs to happen in the next couple of meetings.
Well, on the flip side, a recession could change all of this. It could also force the Fed's hand to cut rates. What are you projecting?
So I think here we need to look at different time horizons. Of course, this bank failures and the stress that we're experiencing in financial markets right now increase the probability of a recession, but I think down the line. And a lot needs to happen between now and then. And a channel through which this can be transmitted in the real economy is through much tighter credit conditions and a credit crunch. But we don't know just yet the extent to which the banking and the financial sector in the U.S. is impaired and what the Fed policy is going to be or the policy response will be. Depending on those two variables, I think we can determine down the line if we are in a credit crunch.
Blerina, the Fed will also release projections for 2023 and beyond. What will you be watching out for in that announcement?
I think the key here will be the dot plot and what they're telling us about interest rate increases over this year and next year. Remember back in December, in the summer of economic projections, they expected peak interest rates at 5.25. Based on data alone, they would have the markets expected the Fed to increase the peak interest rates. The other information we got from the summary of economic projections last year was that the Fed was expecting to remain on hold throughout this year once reaching peak interest rates, and then to only cut in 2024. And my question here would be, are they going to signal cuts already coming towards the end of this year, or they stick with their narrative that they reach peak interest rates this year, remain on hold for longer, and then only cut in 2024?
Blerina Uruci, thank you.
Thanks for having me.